This video reveals a secret weapon for escaping the 9-to-5 grind. We'll show you a strategy that is so powerful that you can start building a $3,000 a month income stream with just $25 a week. That's less than your daily latte habit. So without any delays, let's get started. Meet Jamie, a 25-year-old who starts investing $25 weekly in dividend stocks. After 5 years, she's put in $6,500, growing to $7,800 with $312 yearly dividends. Fast forward 10 more years, her $19,500 investment becomes $35,000, yielding $1,400 annually. But how is that possible? Investing $25 per week might not seem like a big deal, but over time, it can become a solid stream of passive income. This may seem like a small amount, but your money can grow substantially with consistency and smart investment choices. Let's explore how this seemingly trivial amount can grow into a monthly dividend income of $3,000. The journey to financial independence through dividend investing is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. It is like planting a seed that will grow into a mighty oak tree over the years. You're not just saving money, but nurturing a money tree that will bear fruit for years. But what exactly is dividend income? Dividend income is a form of passive income that investors earn from owning shares in companies. When a company makes a profit, it can choose to reinvest that money into the business or distribute a portion of it to its shareholders in the form of dividends. Dividends are typically paid out in cash, but they can also be issued as additional shares of stock. Understanding how dividend income works is crucial for building a portfolio that generates steady cash flow over time. To begin with, let's define dividends. Dividends are payments made by a corporation to its shareholders, usually derived from the company's profits. When a company earns more money than it needs to reinvest in the business, it might distribute some of those earnings to shareholders to reward them for their investment. These payments can be made regularly, such as quarterly or annually, or on a special basis, depending on the company's financial health and dividend policy. An investor's dividend income depends on several factors, including the number of shares they own, the dividend per share, and the frequency of the dividend payments. For instance, if you own 100 shares of a company that pays an annual dividend of $2 per share, you would receive $200 in dividend income each year. Another critical aspect to understand is the dividend yield. The dividend yield is calculated by dividing the annual dividend payment by the stock's current price. For example, if a stock is priced at $50 and the annual dividend yield is $2, the yield is 4%. This yield represents the return on investment from dividends alone, without considering any potential capital gains from an increase in the stock price. Now, not all companies pay dividends. Typically, it's more established, profitable companies that do so. These companies include utilities, consumer goods, healthcare, and financial services. They are often called blue chip stocks, many of which are part of major indices like the S&P 500. Think of big names like Coca-Cola, Johnson & Johnson, or Procter & Gamble. These companies have been paying dividends for decades, increasing them yearly. On the flip side, younger, fast-growing companies often reinvest all their profits into the business rather than pay dividends. Amazon, for instance, doesn't pay a dividend, preferring to use its cash for expansion and new ventures. When a company decides to pay a dividend, its board of directors declares the amount, usually expressed as a dollar amount per share. For example, if you own 100 shares of a company that declares a 50-cent quarterly dividend, you'll receive $50 every 3 months. This might not sound like much, but it can add up quickly if you own shares in multiple dividend-paying companies or reinvest those dividends to buy more shares. Consider reinvesting, a key strategy many dividend investors use to accelerate their wealth building. Instead of pocketing the cash from dividends, they use it to buy more shares of the same stock. This creates a powerful compounding effect over time. As you accumulate more shares through reinvestment, your future dividend payments grow larger, allowing you to buy even more shares. It's like a snowball rolling downhill, gathering more snow and growing bigger. Dividends are typically paid quarterly in the U.S., but some companies pay monthly or annually. The frequency can vary in other countries. For instance, many European companies pay dividends twice a year. It's important to understand that dividends aren't guaranteed. A company can reduce or eliminate its dividends if it's facing financial difficulties or needs to conserve cash. That's why dividend investors often look for companies with a long history of not just paying, but increasing their dividends year after year. These companies are known as dividend aristocrats if they've increased their dividend for at least 25 consecutive years. Dividend income is generally treated more favorably than regular income when it comes to taxes. In the U.S., qualified dividends are taxed at the lower capital gains rate rather than as ordinary income, which can make dividend investing even more attractive from a tax perspective. Now, there are various approaches to dividend investing, each with its own merits. One strategy focuses on stocks with low initial yields but high dividend growth rates. These companies might start with a modest 1 to 3% yield, but they consistently increase their payouts year after year. Tech giants like Microsoft or consumer staple behemoths like Procter & Gamble fall into this category. While the immediate payoff might seem small, the compounding effect over time can be jaw-dropping. You start with $1,000 and add $25 weekly to a portfolio of dividend growth stocks. These stocks yield about 2.4% initially, but increase their dividends by 10% annually on average. It may take around 37 years, but you could look at $3,000 monthly dividend income. That's right, from just $25 a week. Some folks might balk at the idea of waiting nearly 4 decades for this payoff. Fair enough, but remember, Rome wasn't built in a day or financially independent. Plus, this is based on a minimal investment. Bump that to $100 weekly and you could shave a decade off that timeline. On the flip side, there's the high yield approach. This strategy involves investing in stocks or funds that offer juicy yields immediately, often in the 7 to 8% range. The JP Morgan Equity Premium Income ETF is an example of such an investment. With this approach, you might reach that $3,000 monthly income goal in about 43 years. The trade-off? These high-yield investments often have lower dividend growth rates, so while you get more income up front, you might miss out on some long-term growth potential. But why choose? There's a middle ground that combines the best of both worlds. Imagine a portfolio with a respectable 4% yield and a solid 7.6% dividend growth rate. This balanced approach could get you to that $3,000 monthly dividend in about 36 years, the quickest of all the scenarios we've discussed. Now let's discuss real-world applications. Building a dividend portfolio isn't just about picking the highest-yielding stocks. It's about creating a diversified mix of reliable dividend payers. Think of it as assembling an all-star team. You want players with different strengths who complement each other. For instance, include some blue-chip stalwarts like Johnson & Johnson or Coca-Cola. These companies have been paying and increasing dividends for decades. They're like your team's seasoned veterans, reliable and steady. But maybe there are better growers. Then, add some dividend growth superstars. Companies like Visa or MasterCard might not offer high yields now, but they're increasing their payouts at double-digit rates. They're the young talents on your team, full of potential and ready to shine in the long run. Investors can also gain exposure to dividend income through mutual funds and exchange-traded funds, ETFs, that focus on dividend-paying stocks. These funds pool money from many investors to purchase a diversified portfolio of dividend-paying stocks. This diversification can reduce risk and provide a more stable income stream than investing in individual stocks. As we told you earlier, one popular type of dividend-focused fund is the Dividend Aristocrat Fund. These funds invest in companies that have increased their dividends for at least 25 consecutive years. Investing in dividend aristocrats can provide a reliable source of income and the potential for long-term growth. Another option is real estate investment trusts, REITs, companies that own, operate, or finance income-producing real estate. REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends, making them a popular choice for income-focused investors. REIT dividends are generally higher than those of other stocks, but they can be more volatile due to the nature of the real estate market. When building a dividend income portfolio, investors must consider their own financial goals, risk tolerance, and investment horizon. While dividend-paying stocks and funds can provide a steady income stream, they are still subject to market risks and fluctuations. A diversified portfolio that balances dividend income with growth and other income sources can mitigate these risks. Spread your investments across different industries. This way, if one sector takes a hit, your entire portfolio doesn't go down. It's like not putting all your eggs in one basket, or in investing terms, not putting all your dollars in one stock. Remember, dividend investing isn't a get-rich-quick scheme. It's a slow and steady approach to building wealth. Think of it as a financial crock pot rather than a microwave. You're slowly simmering your way to financial independence, letting time and compound interest work their magic. And once you reach that $3,000 monthly dividend income, the growth doesn't stop there. It accelerates. The time it takes to double that income, it's much shorter than the time it took to get there in the first place. That's the power of the dividend snowball effect in action. Of course, this all assumes a steady market and consistent dividend growth. In reality, there will surely be ups and downs. Some years your investments might soar. In other years, they might take a hit. That's just the nature of the stock market. It's like sailing across the ocean. There will be calm and stormy days, but if you stay the course, you'll reach your destination. It's also worth noting that thanks to inflation, $3,000 a month might not have the same purchasing power in 40 years as today. But remember, we're talking about a minimal investment here. Most people can invest more than $25 a week, especially as their income grows. The key takeaway is that small, consistent investments can yield significant long-term results. It's not about timing the market, it's about time in the market. Every $25 you invest adds another brick to your financial foundation. Over time, those bricks add up to a fortress of financial security. So remember that every dollar counts, whether you're just starting out or well on your way to financial independence. That $25 you might spend on a fancy lunch could instead be the seed that grows into a mighty dividend oak. It's all about making conscious choices and playing the long game. Now, as a savvy investor, the decision is yours to make. Assess your financial goals, risk tolerance, and investment horizon. And remember, while the initial amounts might seem modest, the long-term benefits of disciplined investing can be nothing short of transformative. Whether you're 20 years old or starting later in life, the sooner you begin, the more time you give your investments to grow and flourish. In the end, building wealth through dividend investing is a journey. It requires patience, discipline, and a bit of faith in the power of compound interest. But the rewards can be life-changing for those willing to stay the course. So why not start your journey today? After all, the best time to plant a tree was 20 years ago. The second best time is now. Now, let's give it a wrap. Don't forget to subscribe before leaving. Thanks for watching.